Why most of the sugar import business from Brazil to China is fake. Importing sugar might seem like a sweet deal, but beneath the surface, it's filled with complexities and traps, especially for ordinary private companies in China. Few can actually profit from importing sugar from Brazil. Let's break down why most of the supposed sugar import deals from Brazil are fake, or simply unfeasible. 1. The quota magic show. Lots of quotas, but not enough to go around. First off, many people don't realize that China's annual sugar imports are subject to strict quotas. In 2024, the total sugar import quota was set at 1.9 for 5 million tons, and most of this is controlled by state-owned enterprises. To put it simply, the national team gets the lion's share, while private companies are left with crumbs. Ordinary private companies, even if they qualify to buy sugar, can only get a tiny portion of this quota out of the 303 companies that qualified for quota allocations. The average share for each company is less than 3,000 tons. For private companies aiming to do big business, this tiny quota is hardly enough to cover costs. The quota system may look shiny on paper, but the reality is far from it. This explains why claims like, "We can import large amounts of Brazilian sugar" are often too good to be true. 2. High taxes sour the deal. No quota, no profit. What if you try to avoid the quota system and buy sugar directly from Brazil? Be prepared to pay a massive amount of taxes. Sugar imported without a quota can face a tax rate of up to 50%, which significantly eats into the already slim profit margins. In short, before the sugar even lands in China, half your potential profit is gone. Many private companies dream of importing sugar, but when faced with the staggering tax costs, they quickly realize that the math just doesn't add up. The high taxes turn what seems like a lucrative business into a financial nightmare, where companies find themselves losing money rather than making it. 3. Unpredictable market. Price fluctuations crush the dream. International sugar prices also make these import deals risky. In 2023, Brazil had a record-breaking sugar season, and you'd think this would be the perfect time to import. However, sugar prices have been all over the place. For example, in July, China loaded 750,000 tons of sugar from Brazil, significant, but still far below expectations. Chinese buyers missed the best opportunity earlier when sugar prices dropped. For private companies, this kind of market volatility means that even if they manage to import sugar, they could end up buying at a high price and be stuck with unsellable stock if the market turns. The unpredictability of sugar prices adds yet another hurdle to profiting from imports. 4. Fraud is rampant. Fake sugar deals everywhere. You might hear someone confidently claim they can help you import sugar from Brazil, and maybe even in large quantities. But in reality, many of these promises are just hot air. Fraud in sugar import deals is rampant. Some unscrupulous individuals exploit the desire of companies to import sugar by making false promises and setting up fake contracts, all while planning to pocket the money. In some cases, companies claim they can bypass the quota system and bring in massive amounts of sugar. But in truth, they lack the ability to import at all. Many investors fall into this trap, believing in a deal that doesn't exist, only to lose their money. 5. A state-controlled market. Private firms can't compete. Lastly, China's sugar import market is largely dominated by state-owned enterprises, SOEs. Out of the 5 million tons of sugar imported annually, the vast majority of the business is handled by SOEs. These companies not only have the quotas, but also the ability to handle high taxes and market fluctuations, enabling them to make large, profitable deals. For private companies, competing in this environment is nearly impossible. Summary: most of the claims about private companies importing large amounts of sugar from Brazil are unrealistic, and some are outright scams. High taxes, quota restrictions, unpredictable market fluctuations, and widespread fraud all make it incredibly difficult for private companies to succeed in this business. In a market dominated by state-owned enterprises, private companies are better off thinking twice before jumping into this seemingly sweet deal. Thank you for watching. If you enjoyed this video and want to stay updated with the latest insights on international commodity trading, don't forget to hit the subscribe button and turn on notifications so you never miss out. Also, if you're looking to post or find leads for your next trade, head over to our website at www.worldtradepro.com, your go-to platform for connecting with real traders and unlocking new opportunities in global markets. Let's grow together.